Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, how difficult is stock trading? Answer by Shrish Nanda. It is easier than you think. It is also difficult than you think. It all depends on how you approach day trading concept. Some people think that day trading is too easy and a rich quick scheme. No, it is not. It holds your time, your money, sometimes your relations, much dedication, and along with these your strategies. Most of the people who want to be a trader and dedicate their lives to fluctuating numbers. Some of the traders also quit the 9-to-5 jobs. This is not easy. This is not difficult. If you have well-written strategies, perseverance, you will win in this race. You don't need to have successful in every trade. A good strike rate will push you to profits. So if you want to be a successful trader, here are the few things you need to have. A new trader would not have to look far to come across the well-known saying, plan your trade and trade your plan. Treat trading like the business. As a hobby, trading quickly gets expensive. Just dabbling can prevent traders from gaining the proficiency and experience they need to become consistently profitable. Risk only what you can afford to lose. While traders plan on making money, that's why people trade. After all, it is important to acknowledge that it does not always work out that way. It is essential that the money used to fund a trading account be what can be lost without impeding the ability to meet other financial obligations. Develop a trading plan based on your own research. A trader's own research, not emotions or speculation, should be the driving force behind developing a trading plan. With so much information readily available in the public domain these days, it may be tempting to rely on someone else's work or research. This can backfire for a few reasons. Know your exit strategy. Before entering any position, traders should have an exit strategy in place. This should be included in the trading plan and define how the trader will get out of both winning and losing positions. Many traders agree that money is made in the exit. This means that regardless of where a position is entered, it's the exits that determine if it will be a winning or losing trade. Manage risk and protect capital. Properly managing risk and protecting trading capital is what keeps traders in the game. They also should avoid risking too much on any single trade. The generally accepted industry standard is to risk no more than 2% on any single trade. Many traders with smaller accounts find this limits their ability to make substantial profits and may, as a result, risk far more. All it would take is a series of losing trades to destroy the account. Trading with a stop loss is another way to manage risk and protect capital. A stop loss limits the risk that a trader is exposed to for each trade. We all would like to always exit with a profit, but that is not realistic. Because losing trades are inevitable, it makes sense to know how big those trades are going to be. If the trade moves in the wrong direction, it is closed and the trader moves on to the next opportunity. Know when to stop trading when the trading plan is ineffective and losing more than anticipated in historical testing. Markets change, interest and volume in particular trading instruments vary, and trading plans simply may not perform up to expectations. It may be time to take a step back and reevaluate the trading plan, remaining businesslike and unemotional throughout the process. An ineffective trading plan is a problem that needs to be solved. It does not necessarily mean the end of the business. Accept your losses but learn from them. Although most traders inherently focus on winning, trading is mostly about losing. In fact, successful traders think of trading not in terms of how much they can win, but how much they can afford to lose. Losses are a certainty in trading, and despite claims that some trading plans or systems are 100% profitable, the reality is that many successful plans win only about 40% of the time. The key is to make more on each winning trade than is lost on each losing trade. This is what allows traders to make money over time. Finally, get a reliable online discount broker account like Zerodha, which is cost-effective. Only 1% or 20 rupees/executed trade and delivery transactions and investments are free or zero brokerage. To know why am I suggesting Zerodha and to know their products and offerings, click here. If you like their prospects and would like to create an account with Aadhaar card in 2 minutes, click here. Answer by Puneet Keesar. Most of us think, or are made to think, that stock market trading is a tough route to consider investment. But it's not as tough as it seems. Though I won't say it's way too easy. In my opinion, stock market trading requires knowledge, patience and commitment. If you have these three in you, it won't be too tough. Apart from these qualities of yours, you need a stockbroker that understands and complements your requirements. A stockbroker that provides each and every solution that you require. If you are stuck with a broker that's not supportive, will eventually make trading a tedious job for you. Hence, selecting a perfect stockbroker for your needs is of utmost importance. Also, you need to learn few simple yet fruitful trading techniques. On the basis of these techniques, you can derive a trading strategy to suit your requirements. Like, if you want to just spend few minutes every day, you can opt for options trading only. Based on your strategy, you can create your trading portfolio. I'm sharing these details, as it is necessary for you to keep track of things. I've seen that people who are not maintaining their portfolio do not have control over their profits and losses. I'd suggest you to learn few golden rules for beginners which are available on multiple places like blogs, or on a stockbroker's website. Also, watch few videos in NSE tutorial. Try to keep track of the financial markets on regular basis and follow top financial blogs for updates. Answer by Grant Gigliotti. Stock investing is easier than it seems. The financial industry would like for us to think that we can't invest on our own, because that means they can keep taking away our hard-earned money through expensive fees via their inferior performing mutual funds. Here's how I would do stock trading step by step. 1. Sign up for a free online trading account with one of the reputable online brokerages that charge a low trade fee, less than $10 per trade, such as Scottrade, TD Ameritrade, Trade King, Charles Schwab, etc. 2. If I intended to keep my money accessible, then I would open an individual account, so it would be easy to withdraw money when I needed it. If I were planning to not touch the money for a long time, then I would open a Roth IRA or traditional IRA. The IRAs can really help to grow my money faster because of the tax advantages. If I thought that my tax bracket would be higher at retirement age than now, then I would consider a Roth IRA. If my tax bracket is higher now than I think it would be at retirement age, then I would consider a traditional IRA. 3. Now it's time to pick a company to invest in. I would only consider companies that I know of and understand. 4. I'd consider products that I love to use and have used on a repeated basis for years. Then I'd look up the companies that make these products and see what the stock symbol is. These would be good potential companies for me to invest in. 5. I'd only invest in this company if I believed in it and thought it would be around for the next 10 years plus, still producing the same product or service. Warren Buffett says if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. 6. I would invest with the mindset of keeping the stock for long term, even if I will probably sell much sooner than that. 7. I'd only invest in a few companies, maybe 15, that I could keep updated on from time to time. To stay updated, I could set an alert with my online brokerage to receive email notifications about important news of the companies I invest in. 8. Once I've found a good company for me to invest in, I'll also want to make sure that it's at a bargain price before I buy it. 9. I'd want to make sure that this company is selling for less than its value. I would do this by looking up the stock symbol's P ratio to see if it was 15 or less. Or an even better way is for me to use a stock analyzer such as the BTMA Stock Analyzer, free trial, to quickly find good companies at bargain prices. 10. After finding a good company at a bargain price, I'd set a limit order to buy the stock at the lowest price I felt it could go down to in the following weeks. One way to do this is to look at a 2-year chart of the stock and pick a price that is close to the low price range over those 2 years. Yahoo Finance, Google Finance, and Morningstar offer historical stock price charts. 11. Immediately after buying the stock at my bargain price, I will set a limit order to sell the stock. When choosing my sell price, I would ask myself what return I'd be happy with that is realistic within the time frame that I want to sell within. Again, I could use the historic price chart from before to help me see what is a realistic return within various time frames. For example, if I think a 5% return within 3 months is realistic for this stock and that I'd be satisfied with that return, then I would set the limit order for 5% over the price that I originally bought the stock. 12. If my stock goes down in price, I won't worry. This is normal. Stock prices go up and down. If I am sure that I bought a good company at a bargain price, then I don't have much to worry about. I can just wait until my stock goes back up in price to cross my sell price. However, I could consider selling my stock before reaching my selling price only if something significant and permanent happened to the company that completely changes the fundamentals, structure, and profitability of the company for the long-term future. For example, if I owned the typewriter company stock and the computer made the typewriter obsolete, then I would definitely think about selling my typewriter company stock. 13. Once I sell my stock, I could immediately set another limit order to buy the same exact company again at the same original buy price and repeat the process, if I still think the same company is a good company. In the meantime, I can start looking for another good company at a bargain price to invest in and do the process again and again. I hope this info is useful for you.